please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, yesterday was all about Davos and all about Sensex at 36,000 and Nifty at 11,000. Good morning, Anuj. It looks like it's going to be another day, another high. There is only good news, as we can see, across whether it's Wall Street or Asia. And it's, you know, both earnings and growth coming along with the higher market prices, whether it's Netflix earnings 10% higher or the Japanese import growth. Everywhere, the story is one of growth. And even our zone, I mean, look at Indiabulls real estate numbers. There are some mind-boggling improvements in earnings, albeit from a low base. So, well, looks like we can put Bazaar on autopilot and it's another day and another high.
Yeah, morning, Lata. And of course, missing Sonia right now.
Absolutely.
You know, so obviously, maybe the SGX Nifty is down a bit right now. But look, we are in a melt-up phase. The expiry momentum is with the bulls. Problem is, it's easy for those who have been, invested in this market to just ride this momentum. And, every day the call of correction is actually hope for correction. So they don't care. But the problem is, if you're buying afresh now, what do you do? Because if you're when you buy in a market, if you're a trader especially, you buy with a stop, right? Right now the problem is that the stop loss would be very deep. Very deep, because the Nifty's 20-day moving average is 10,655. The Bank Nifty is at 25,900. So the Nifty is 4% and Bank Nifty 5.5% away from their 20-day moving average. So logical stop loss. Will a trader have a 4% stop loss on an index, 5.5% stop loss on an index? Logical stop loss, not the maximum amount of money that you can lose. That, I think, is a bit of a problem. The good point about last rally, though, has been that it squarely belonged to the large caps. And, you would hear a lot of people say that they have not made too much money in the last round of rally. They made a lot of money in 2017. They may not have made too much money in the last couple of weeks because it's been led by stocks like TCS, where, retail shareholding is not too much, right? So that, for me, that's an indication that maybe the time is ripe for you to, once again look at your portfolio and move to large caps or largish mid caps. I think that's the better strategy right now. This market is vulnerable to a correction. Whether it happens or not is anyone's call. But you don't stop buying because, the market is overheated and is vulnerable to correction. So really, it's, it's a tough call right now to take a fresh call. For those who have been staying invested, I think maybe at every 10% you want to take 10% off and move to some cash, and at maybe if the market gives you lower levels, buy. But next time the correction comes, I think the market's message would be clear that you got to buy. I was just reading a comment from one of the leading hedge fund managers this morning that if you're staying in cash, you'll feel stupid 3 months down the line. So that's a big call. This is a melt up, and normally you make the most money if you stay invested through the melt up, but if you know when to take the foot off the pedal. Yeah. I think that's the toughest call right now. Okay,
well, you have a lot of advice for traders, but I would think for an investor, the big shift now that has happened in the last 3 months, last 3 days, and maybe in the last 3 weeks, is that FIs have turned big buyers.
Yes.
I mean, it's now becoming a minimum of 1,000 crore a day. So, in this phase, even if you bought at current levels, perhaps you're not really a loser.
Exactly.
It's only, maybe you wait 48 hours instead of 24. But it looks like there's one big buyer who suddenly emerged on the horizon.
And you know what? And look at the delivery numbers in some of these big names. You spoke about TCS 2 days back. Look at State Bank of India yesterday and the kind of delivery buying that you had on that stock yesterday. So obviously there's a lot of buying. But we're talking about the FIIs and the investments and the investors, Lata. You and Sonia, of course, I missed this event yesterday because of some personal commitment. But what were the key takeaways from, the conversations that you had? Well,
it was really a budget brainstorm. So one of the, obviously, the talking point became long-term capital gains. And the verdict of those veterans, and Rhythm and Nilesh and these guys know the markets like the back of their hand. They feel that if this long-term, short-term became instead of 1 year, 2 or 3 years, that's factored in. It's not going to have any impact. If a new long-term capital gains is imposed, then there will be a squabble on whether it is instead of STT, whether it is an STT set-off. So, that could be a bit of a niggling worry for the markets. That was, of course, one big takeaway. The second takeaway from, not just from the economists, from others also, is that they better stick to fiscal prudence because already yields are rising.
Yes.
But the point is the government may be in a position to stick to fiscal prudence because you should think of higher earnings next year. All commodity prices are higher. So you can assume a nominal GDP of 12% and therefore a good tax buoyancy and therefore a 14% rise in taxes, and GST will be in place. That of course is not priced in. You can't put a number to how good GST can be because the e-way bill can bring more people. So the assumption is that government should be fiscally prudent, but it can be because there will be more money. The big problem only will be that fuel excise hike will not be available.
Yes.
So that will put a bit of a pressure, but that can be borne by higher revenues is their expectation. The third takeaway was that government should not look at higher taxes. There should be no source of extra taxes, but it should touch non-tax revenues. So more dividends from PSUs, more sale of VSNL land, which can still fetch. The usual thing that, non-tax revenues. Yes. And finally, they expect that the dividend distribution tax won't be touched because it's too much of a sitting duck to tell companies you don't tax, I'll take it from individuals. And what if, you're not able to be very successful with individuals? So they don't see the budget having any negative impact. And of course, farm-focused budget. I guess that goes without saying. That was the long and the short of that discussion. We'll play out. It's much more interesting when you hear it from Rhythm and you hear it from Nilesh and Sajid and Dinesh Kalabar and Abhay. But for the moment, here are some more equity advice coming from experts before we start trading. This one comes from Jonathan Garner of Morgan Stanley. He says the rising risk of trade protectionism is one of several factors which we think could cause the bull market in Asia emerging market equities to wane as the year goes on. He says markets in EM with most revenue exposure to the US in listed equities are Taiwan, Mexico, Japan, South Korea and India. For Asia ex-Japan, the most exposed sectors in terms of revenue are IT, followed by energy and consumer discretionary. So they're worried about that, looks like. Jonathan says Japan has considerably larger geographical revenue exposure to the US in key large cap sectors like consumer discretionaries, healthcare and IT. So all this is a result of Washington imposing a tax on washing machines.
Okay, let's look back home. Sanjay Mookim of Bank of America Merrill Lynch says that it's limited possibility of Budget 2018 delivering reason for material upside to an already inflated equity market in India. He stays cautious with the December 2018 Sensex target of 32,000, which is 10% down from here.
Well, the 5 gurus in the budget brainstorm didn't sound all that cautious. So you should pick your stocks with care, as you say, stick with quality and large caps. But nobody was really calling a top anytime soon. Yes, 2018 gains will be more modest than 2017. That possibility definitely exists. But nobody was really expecting the markets to take a U-turn anytime soon.
I tell you one thing. Either we'll have 2018 even outstripping 2017 or will we have a big correction. I don't buy this theory that, the market will gain but maybe less gains than 2017.
You're right in the sense that people extrapolate the present.
Exactly, exactly. So, and there's a good chance that we have a year of 2 halves. First half, the market just melts up and, makes the last bear throw in the towel, just makes everyone so miserable, especially those who are missed out. I've heard people saying from 28,000 that at these levels I will not buy. And, those would be the people who might turn out and start buying at 40, 42,000. And at that point, maybe the market decides. Last time, I'll just give you an analogy. Last time, everyone keeps talking about the last bull market. Every bull market is different. Last bull market had, at least 3 instances of 10% correction, 20% correction, 30% correction. Yes, but at what stage of a bull market? Not in a nascent bull market. The Nifty in the last peak, 2008, the Nifty was at 6,000 something. We're not even at 12,000. In 10 years, we haven't even doubled from the last peak. In the last bull market, when those corrections happened, the Sensex first went from 4,000 to 16,000. And, above that, after that, you had that 10%, 20% correction. Yeah. So it quadrupled before it, gave that correction. I think that point should not be lost.
No, there are 2 or 3 points in what you're saying. I'll just say whatever occurred to me. In the last bull market, we produced 8% GDP growth every year. Now, we have not yet reached that stage. Secondly, in the last bull market also, we had 2 years back-to-back 30% earnings growth.
Yes.
Sensex growth. So, repeating a similar number is possible. It has not happened, not happened in the past. And of course, the big rumor that was there in the audience yesterday, and one guy actually asked that as a question, ये 46,000 जाएगा और फिर गिरेगा. I don't know. He said it's a big buzz. The market believes that it'll go. So anyway, I didn't even want to put it on the table, but there was this buzz among the audience. All right. So that that is part of what you're saying. A huge melt up and a huge meltdown. Pretty much possible. Okay, we have to get your money market views as well. Not a very active market today. Praveen Brahmata Veracity says there would be range-bound trade in the rupee in the absence of any cues. He expects spot USD INR pair to trade in a range of 63.80, 64. The dollar has actually declined.
Oh yes, and let's get you some money market, the bond market view as well. Dhawal Dalal of Edelweiss says that there's fair bit of optimism in the air from Davos to Delhi. He says in India the government's optimism on revenue collection trend may have facilitated them to reduce the borrowing in scheduled auctions. He says bond market participants are pleasantly surprised with lower supply and are reworking their math for fiscal deficit and the net borrowing next year in the union budget. As a result, he expects the 10-year yield to trend lower in the near term. So that's a positive.
Oh, that's a very big positive, especially for NBFC stocks. Which get impacted immediately. And even over there, there was a lot of optimism in the air among the tax guys who attended the conference that the e-way bill is going to give mind-boggling revenues in GST as early as this year itself, February and March. But let's wait and see for those numbers. Over to Nigel now for the World View.
Well, yet another session when the U.S. markets hit all-time highs. The Dow, in fact, hit it intraday and then came off. In fact, ended more or less flattish, while the Nasdaq and the S&P 500, both of them did end at fresh lifetime highs. Netflix, that's the stock really that was in focus. The numbers look very, very good. In fact, it ended higher with a gain of close to around 10%. And now, in fact, the company has joined the $100 billion in terms of market capitalization. The total additions now at around 8.3 million. The expectation was it'll climb to around 6.5 million. So that looked very, very good. In terms of earnings reactions, and one reason why, in fact, the Dow did underperform, we have Johnson & Johnson as well as Procter & Gamble. Both of them came out with this set of numbers. They look better, but came in for profit booking. Even in terms of Verizon, there it was a mixed set of numbers. That stock as well ended in the red, and that explains why, in fact, the Dow was a relative underperformer. Shifting focus to the European markets, the CAC was a relative underperformer there, while you had the DAX and the FTSE, both of them ending in the green. Coming to the Asian markets, though, today we have the Nikkei. That one, in fact, is under some pressure. We are seeing some strength on the yen. Not very good news for exporters of them. And we had the export data as well. That came in a tad bit lower than what the street was working with. The rest of Asia as well, trading more or less in the red. I think only the Shanghai market as well as the Kospi, they're more or less flattish with the mild positive bias. And for starters, the SGX Nifty suggesting maybe we'll see a downtick, but interesting to see whether or not that dip is bought. Back to you.
Okay, Nigel, thanks a lot for that. 22 points on the SGX Nifty. Jeffrey Dennis is with us, Head of Global Emerging Market Strategy at UBS. Jeffrey, good morning. Good to have you on the show. Big move in Indian market over the last fortnight, sensing a bit of a melt up. What's your call on Indian market at these levels?
Well, when we launched our 2018 outlook for EM equity markets early in January, we actually downgraded India from overweight to neutral. So we're a little bit more cautious on India now. Basically, of course, you know what that means. It means that we think India is going to be more in line with emerging markets overall. And so, although India has obviously done well in the last, as you say, in the last 2 or 3 weeks or so, of course, emerging markets have risen very strongly indeed. And year to date, EM is up over 7% already. So India is actually underperforming. So I think you have to look at the strength of the Indian market in the context of this, as you said a few moments ago, this melt-up we're getting in equity markets generally.
Okay. Good evening, Jeff, and thank you very much for staying up for us.
Good evening.
But, therefore, what do? You don't buy incrementally because some of the numbers looked very good. So is there any selective purchases on your part?
Well, I mean, just to go through the story, I mean, the point we're trying to make about India is that obviously it had a very, very good year last year. It was up in dollar terms over 35%. It outperformed. And our sense is that it really shouldn't have outperformed as well as it did. This was a year that was driven by China. It was driven by technology. India has some tech stocks, of course, but it's not a very big weight in the market. And a lot of great economic links with China, of course. And as you know very well on the program, we saw really quite disappointing earnings last year in India, whereas most countries' earnings were being revised up. In India, they're being revised down. what seemed to be driving the market, and you will know this better than I do, that the money was coming out of the property market post-demonetization.
Yes.
The domestic flows were quite strong into equities, whereas the foreigners, I think, net were selling. So we had that view, more cautious view. It's a sort of tactical view in the short term heading into 2018, simply because we think valuations had gone up too much. And that's really the basis of our view. Now, of course, there are sectors that we like, and referring really to the work that our Indian strategist Gautam is doing. We like auto parts, we like IT services, we like the private banks, we like telecoms and media. So certain sectors that we like. But I think we're just saying here, in a year that we think will deliver some more good gains for emerging markets, although frankly, this has been a much stronger start than we thought would be the case.
Yes.
We just don't think we're in a situation here where India is necessarily going to be an outperformer, even though I think the long-term story in India remains very, very good indeed, and it's probably still long-term the best growth story in the emerging markets. It's just I think the market had gone up too fast.
Okay, but Jeff, also what's interesting is that foreigners have started to buy big in India. All through last year, that was the missing piece. But the last 3 or 4 days, we have seen huge buying in India's largest stocks like TCS, Reliance, HDFC Bank. Big buying happening here. What would explain that?
Well, I think what's interesting about that is I'm aware that you're seeing that. And I think what's happening here, it's a couple of things, and they're entirely related. One is, of course, as I say, the strength of markets overall. I haven't done the calculation after today because I'm traveling at the moment, but we're up after, where are we now, after Monday, 6.9% on the year, so it's probably not far short of 8%. So there's a general big move higher in dollars in emerging markets, but also there has been an enormous inflow of money into emerging market funds at the beginning of 2018. So last year we had $65 billion into emerging market funds. So far this year, we've had $8.5 billion.
Wow.
So we've had 1/8 of the whole of last year's flow. So I think what's happening is flows are going across the emerging market.
Okay.
So I'm not sure the foreigners are should we say, separating out India as a place to put money. I think they're putting money everywhere.
Okay. Oh, that's a point we hadn't noticed at all. Jeff, finally, what would you expect from the Indian budget? Is that something that enters your calculation at all when you make allocations?
Yeah. Yes, it does. I mean, obviously, we've had a track record in recent years where the budget has been a market-moving event. I think that we're looking for a relatively prudent budget, sensible budget, without there being any major increase in the budget deficit target at all. Indeed, probably the target's going to come down slightly. But I think with the medium and long term in mind, i.e. the approach of the 2019 elections, which are not far away now, I think what we're watching for is given the relative softness of the economy recently, sliding back to probably 6.5% growth in fiscal 18, which we think will go back up to 7.4 in fiscal 19. But we're looking to see whether the government really tries to inject some more spending into the economy on the fiscal side. So the market will be very wary and very nervous about seeing some significant fiscal expansion. Probably not going to happen this year, and if growth comes back, it may not be necessary. But that is something, of course, that the government could look towards doing in the event, in the run-up to the elections in 2019.
Yep, that is one fear. Thank you very much, Jeffrey Dennis, for giving us that FII perspective and that very important point that emerging markets have got a huge amount of money, huge allocation of $8.5 billion year to date itself. That explains the inflows into India as well. I think we should continue with this. We head back to Davos now, where Shireen Bhan caught up with a whole host of India Inc. And important among them was Uday Kotak, telling Shireen that there is no bubble in the market right now, but he does believe that a risk looms. Listen in, we'll take a break and we're going to come back with our entire team and detail to you the list of stocks that we are watching.
The market continues to rally irrespective of concerns on valuations and so on and so forth. What is getting you worried at this point in time?
First of all, money makes the world go round. So whether it's global money, which is seeming to be opening the new year with a bang, so we're seeing a positive sign on that. Combine that with the fact that for the first time, many first-time investors have come into mutual funds in hordes. at a time when, thanks to demonetization and GST, we have seen money move away from real savings in terms of real estate and gold into financial savings. So these are newcomers. They are putting money into funds and unit-linked policies and stuff like that. They have not experienced any volatility because they have no history on that.
So are we in the midst of a bubble in that space?
I don't think we are in the midst of a bubble. What I have said is that we risk a bubble if continuing large amounts of money, which on a broad funnel come into a small pipe of a few hundred stocks, and particularly in small and mid cap, where we also have questions about the levels of governance.
Cavell, our research team, is standing by with their TV18 top 10 list of stocks for the day. Anuj, as always, start.
Yes, so Lara, I had flagged this stock earlier as well, Indian Hotels. It's a Tata Group stock and the biggest listed stock. Why it came on my radar today is I was just looking at the stock price. Jan 2008, the price was 156. Jan 2018, the price is 156. So it's breaking out of a 10-year consolidation, if indeed it is breaking out. And there was delivery buying. And as I said, there's been a lot of buying in hotel stocks, and this, of course, is the largest. So that's one to keep on your radar. The other is Escorts. It's a stock which is moving back towards its highs after a brutal correction. Strong delivery buying as well for last few days. So it will be interesting to see if there's any follow-through on this one.
Okay, well, keep those two stocks, but now we'll begin the earnings watch, and I think the first among them would be Indiabulls Housing. Abhishek, a AAA for consistency.
The most consistent performance, and it has been as per the management's guidance on air that they have said every time. Loan growth above 30%, spreads between 3 to 3.25, and gross NPA to be maintained below 1% is what the management had been guiding. And even in this quarter, look at the loan growth at 32% YOY, spreads at 3.22%, versus 3.25. You look at the PAT, there is one-off income in terms of sale in their Oak North Bank stake. So despite that, if you remove that one-off, the PAT has grown by 24%. Gross NPA has also improved to 0.77 versus 0.78. Now CLSA has raised their target price to 1620, that is 1,620 versus 1,500 earlier, and they have maintained their buy recommendation, while Bank of America also has maintained their buy recommendation and raised the target price to 1,830. Back to you.
Okay, Abhishek, thanks a lot for that. So Indiabulls Housing, it's done well over the last 3 days, keep in mind. So over the last few days, from that correction of about 1180 thereabout to 1370, but numbers clearly look spectacular. What about the other Indiabulls companies, Sonal, Indiabulls Real Estate?
Well, I would say that they were weak set of numbers sequentially, though on a YOY basis they did really well. That was because demonetization was in the base. But in terms of sequential, the revenue was up 191%, but the EBITDA, that came down by 22%, majorly because the cost of materials were higher by 526%. All this led to margin contraction of around 3,000 basis points, leading to profit decline of around 9%. If I take you through the fine print, the new sales during the quarter were at around 523 crores. Though the finance costs have gone down by 18%, debt still remains a problem at the 9,000 crore level. And remember, the market cap of the company is at around 11,000 crores. So debt still remains a problem for the company. However, one positive thing from the result is that annualized annuity revenue run rate has been increased by the company to 720 crores versus 692 crores rupees earlier. So let's see how the stock reacts to that.
Okay, yeah, so mixed bag there. But Sonal, no mixed bag when it comes to United Spirits. Very bad to mix your drinks.
Yeah, it is actually. We're estimating really good numbers after exceptional performance in Q2, but it has not only come in lower than the estimates, even on a YOY basis, the numbers are weak. The revenue went down by 8%, the EBITDA was down 7%. All this led to a profit decline of around 9%, and volumes still remain a problem. So in prestige and above segment, which contributes to 48% of their revenues, the volumes declined by 3%, and this is one segment where we were expecting a volume growth of around 5%. So that is definitely a dampener. In terms of popular segment, we were expecting a decline of 12% because they moved to the franchisee segment. But the volumes declined by around 22%, so that is definitely not positive. Even the brokerages are not so bullish. Goldman Sachs has a rating of neutral with a target price of 2,967. Even Macquarie has an underperformed rating with target price of 2,383. They have a conference call at 12, so we'll have to figure out what really went wrong for the company this time.
Okay, thanks a lot for that, Sonal. I just want to point out here one thing. Look at the intraday chart of United Spirits. From 38.25 thereabout, the stock ended in the red, and in a very strong market, ended in the red. So
by 75 rupees.
Yes, obviously someone has gone home with short positions. Now, the point here is that it's sometimes the con call, as Sonal said, is at 12. Maybe the time to short was yesterday when the market was giving you that indication. If you short when the stock opens, say whatever 4 or 5% lower, you're only giving an opportunity to those who shorted yesterday an exit opportunity. And I won't be surprised if there's a bit of a, sometimes with companies like United Spirits, where it's public information that at some point Diageo will make a delisting offer. Sometimes in the past, you have seen this, this conspiracy theory play out with MNCs, where the numbers are bad, the stock corrects, and then after that, there's a bit of a delisting offer. So, and this is a bull market, and the stock has bottomed out in the past. So, I just thought, you be a bit cautious with the way you approach United Spirits today, not necessarily just go out hammer and tong in the morning on the stock.
Lower revenue, lower profit should not mean a shorting opportunity will bring home the bacon.
Exactly.
Well, just beware is the advice. Okay, Syngene Ekta.
Well, good set of numbers, Lata. The revenue was up over around 15-odd%, 16.7% on a year-on-year basis. Margins were over 30-odd%, and the profit figure was up around 10-odd%. Remember that Syngene is coming on the back of a fire which had taken place in the plant as well. So there is some amount of a positive base, but the street was working with around a 10 to 12% growth, so 16% will be taken with both hands positively. Again, commentary will be important. The conference call is at 3 p.m. this afternoon. So I'm sure a lot of brokerages will come out with their notes tomorrow.
Okay, Ekta, thanks a lot for that. Abhishek, what about PNB Housing and RBL Bank?
Well, Anuj, balance sheet growth in PNB Housing has been strong on a quarter-on-quarter. We cannot compare YOY because of demonetization and the base effect. So AUM growth was at 12.5% versus disbursement growth of 25%. Slight hiccup in asset quality, wherein the gross NPA increased to 0.42 versus 0.34. But what baffles me is that the spreads declined on a sequential basis by 65 basis points, but NIM improved by 59 basis points on a sequential basis. That is a key thing to get the highlight from the management. So expect the stock to be in green. For RBL Bank, the strong loan growth and the low-cost deposit share has actually driven the NIM to their highest ever at 3.89%. One account led to increase in gross NPA, which the management expects to recover in Q4. And management also expects the credit cost to lower in Q4 onwards. And core fee income surprised on the positive side, despite the fact that loan growth was at 38%. Fee income grew by 50%, aiding in your earnings growth. So expect that stock to be in green today.
Okay, thanks a lot for that, Abhishek. Naveen, what about other results?
So quite a few other results. In fact, L&T Technologies came up with its numbers post-market yesterday, Anuj. Good set of numbers. Revenue growth was 8%. Margins also remained at that 14%. Remember, this is at the higher level. Swaraj Engines also, the continuous growth seems to be continuing for the company, with the PAT up almost 12.5%. Operating margins are maintained around that 14% levels. On the other hand, Shimaro Entertainment, remember, has seen a good run-up in the last 2 to 3 sessions, up almost 35-40%. That has been shown in the numbers also. Revenue growth 17%. PAT is up close to 27%. At around those 18 crore mark for Shimaro Entertainment. On the other hand, Raffila International, we haven't been talking about this company much, but last quarter it had posted strong set of numbers. Not the case this quarter, clearly. EBITDA down 12%, PAT is also down close to 3%. Now some good numbers, NK Wheels, remember, a strong set of numbers, this Japanese company which is into aluminium casting. EBITDA over here jumped by close to 200 basis points at around 8.8%. PAT has also seen a strong growth. In fact, PAT has come in at 1.5 crore versus a loss of close to 1.5 crore in the base quarter. Nucleus Software also, strong growth continues for this company. Revenue up 6%, but look at the margins, up 200 basis points at around 18%. Last, Wapco India, it seems that the overall auto ancillary, the gear pack, they have been putting good numbers. So you have a PAT up of close to 46%, revenue up by close to 33% for Wapco.
Okay, Naveen, but net, it's more good than bad, or much more good than bad. Shimaro doing well, Netflix doing well. I can honestly admit that I have contributed to the earnings of all these. Big watcher of movies. Okay, that was the earnings stocks to watch. There are other non-earnings stocks to watch as well, which we will put on the table in just a minute. We should be having Ronit tell us the other results that you should watch out for. Ronit, you ready?
So a couple of other results on my radar, Lata.
Okay, we'll just come to you, Ronit, in a minute. There seems to be an audio issue over here. But I think this is today, by and large, other than United Breweries, United Spirits, the earnings don't look like a bad lot at all.
Yeah, they don't at all. In fact, it's, of course, on India Bulls, real estate, the jury is out because, quarter on quarter, there's a bit of a problem. So, of course, we'll flash some of those other earnings as well. But let's... the numbers that Ronit was looking at was, or the stocks that Ronit was looking at was eClerx, where there's a buyback, Alembic also, where there's a buyback, Savita Oil Tech, Sanghi Industries and Majesco. So we'll put some of these on board.
Right. I think Ronit is now back with us. Ronit, you just want to detail to us the stocks on your radar?
Yes, so there are a couple of stocks on my radar, and most of them are buyback as well as QIPs. I'll start with eClerx. They have decided to take a buyback of around 258 crore worth of, and at rupees 2,000 per share. Remember, the record date for the buyback will be around 5th Feb 2018. Moving on to Alembic, another buyback. So they decided to buy back around 1 crore shares at rupees 80. Remember, the stock has been a big outperformer in the last 6 months. Moving on to Savita Oil Technologies, another buyback. They decided to buy back around 2.8 lakh shares, which is around 1.6% of the equity at around 1,600 per share. Moving on to the QIPs. Sanghi Industries, they have closed their QIP at rupees 129 per share, and there was strong demand for that QIP. And finally, Majesco, they've decided to raise funds via QIP at a floor price of 532 per share.
Okay, thanks a lot for that, Ronit. See, earnings were not all that bad, more good than bad, and more people raising money. So all that looks like an economy, or at least a corporate sector on the move. Let's hope. Here's a quick recap of the stocks that are on our top 10 list. Expected to gain are Indian Hotels, Escorts, India Bulls Housing Finance, Syngene, PNB Housing, RPL Bank, L&T Technology, Swaraj Engines, Shimano Entertainment, NK Wheels, Nucleus Software, Wapco India, eClerx, Alembic, Savita Oil, Sanghi Industries and Majesco. Stocks under pressure could be India Bulls Real Estate, United Spirits and Rupfilla International. Okay, that's the stocks that you should be watching. We've been getting you a lot of important voices from Davos, and this one is by far the more important because it's Dharmendra Pradhan. The first time he's speaking after the ONGC HPCL deal. He is promising further consolidation in the oil and gas space. Let's listen in to his chat with Shireen Bhan.
Speaking of investment specifically into the oil and gas sector, what can we expect, sir? Because this is a sector that has seen a bit of a lull in terms of investments. Are we likely to see big ticket FDI return to the oil and gas sector?
I'm confident. Not only FDI, a lot of investment will come. Already there are a lot of investment already on ground. In the Kechi Basin, in Andhra Pradesh, more than 15 billion investment are on job, on the ground. That apart, we are going to build the biggest ever PSU-driven refinery, 60 million ton capacity refinery in West Coast in Ratnagiri. Just now we have started our work in Barmer area, where India produced 20% of its crude oil. A lot of gas is coming up in that area also. Now looking into the incremental requirement of India's market, India is the new destination of investment. A lot of people are coming. Rosneft in last year, the biggest ever investment came to India. Rosneft invested.
What about Saudi Aramco, sir?
They are interested. They are interested for Ratnagiri refinery, for the West Coast refinery. That's one of the agenda I am talking to my counterpart, Excellency Pali.
Let me ask you about more consolidation, HPCL and ONGC done in this fiscal as you had anticipated and as you had told us when we last spoke. What next, sir, in terms of consolidation within your ministry and your sector?
This government is very decisive. What we have promised, what we announced in the last budget, we have already completed that process. Last week we have completed the ONGC HPCL acquisition. It's a very unique and innovative financial integration came up, and as I told, some more maybe come up in the near future.
Have you identified who merges into whom, etc.? What is the...
We are interested to create a grid gas network. So looking into that need, we may have to, we are thinking whether evaluating financially also how things can unfold. But in future, more consolidation, more integration will be there.
Okay, that's obvious. More consolidation and integration will be there. Now, of course, the next one would be IOC. So we'll keep an eye on some of these stocks.